This is the Realist Realtor podcast hosted by Carmelita Turner, the realest realtor you know. Episodes are here each and every Wednesday at 3 p.m. because this is the show where people are interested in engaging in real conversations that talk about real life and how very real situations impact how we are able to leverage our wealth building ability through real estate. We're so glad you decided to join us. Good afternoon, everyone. Welcome to the Realist Realtor Podcast. I hope everyone is having a wonderful Wednesday. Thank you for showing up and rocking with us for another week here during our second season. Wow, we have really been at it for quite some time, and we have many more good seasons to come. So I'm excited about the value that we are able to put out into the world. Last week here on the podcast, we had story time, and I was using the book called The Color of Law, written by Richard Rothestein. If you all have not picked up that book, I strongly encourage you to do so and add it to your library. It is definitely a good book, and it talks about the forgotten history of how our government segregated America. But I wanted to kind of give you all some perspective last week on how the decline in city dwelling started. I wanted to give you some history on segregated housing and neighborhoods, bias in lending, bias in neighborhood valuations as far as how homes are assessed, redlining, many different things that come out in that book. And I have to be very honest. Everything I talk about on any of my platforms is not hate speech or divisive. It is all factual, documented, and accurate. It is supported and proven by thousands and thousands and thousands of historical documents and research that has been conducted. But I would be lying if I did not say that as a Black female American entrepreneur with real estate as only one of my wealth building arms, bringing this content and value to my platforms for my listeners is critical so that you can be armed with an arsenal of information that will help inform decisions for you and for your family moving forward. But I will say it definitely takes its toll on me in just, it's almost like when I look at these documents or do this research, I really literally feel like I was living the life that people were living during the 1940s, the 1930s, the 1950s, the 1920s. I don't know. Maybe I've had many parallel existences. I can't say. But I think it's more closely akin to the fact that, unfortunately, many of the things that they were experiencing back then, we are still experiencing now. And for me to know that I've been given the charge to continually speak and share knowledge and educate sometimes can be a little overwhelming. But I shake it off and get the research done, and I bring the information to the listening audience. So hopefully it can help someone along their journey. So today, I still want to kind of tie this up with a bow using The Color of Law and read from the second section of what we discussed last week. If you didn't listen to the podcast last week, I encourage you to go back and do so. And it will definitely give some foundation to what you're going to hear today. So we started talking last week because I was saying how I started my OYO movement years ago, my Own Your Own movement, where you need to not only own your own dirt, own your own doors, but you must own your own knowledge, own your own intellect, own your own education, your own spirituality, your own health practices, right? And I was using the chapter from Rothstein's book that was called Own Your Own Home. So, in the second part of that chapter, I just want to read a couple of sections to you. We're going to have story time again today. And I think it's a perfect day for it. Where I am, it's a bright, sunny, chilly day. So, what better time to have story time? Although the federal government had been trying to persuade middle class families to buy single family homes for more than 14 years, the campaign had achieved little by the time Franklin D. Roosevelt took office in 1933. Home ownership remained prohibitively expensive for working and middle class families. They just couldn't afford it. Bank mortgages back then typically required, listen to this, folks, 50% down, and they were interest only payments and repayment in full after 5 to 7 years, at which point the borrower would have to refinance or find another bank to issue a new mortgage with similar terms. Few urban working and middle class families had the financial capacity to do what was being asked. Well, guess what? Quiet as was kept, few of those rich people had that capacity either. It was almost like, again, mortgage. What did I say that word means? Death pledge. It was like they were in this mortgage for life unless they were able to secure the funds to pay that off within 5 to 7 years. The Depression made the housing crisis even worse. Many property owning families with mortgages couldn't make their payments and were subject to foreclosure. With most others unable to afford homes at all, the construction industry was stalled. The New Deal designed one program to support existing homeowners who couldn't make payments, and they designed another program to make first time home ownership possible for the middle class. So, again, mind you, the concern there is that, hold up, this construction industry is suffering. Let's make sure we can help the people struggling to make their mortgage payments now, which those folks normally fell into the upper socioeconomic level. And then let's also create this new program so that we can now have more people buying home, first time home buyers who fall into the working or the middle class group. So in 1933, to rescue households that were about to default, the administration created the Homeowners Loan Corporation, HOLC. It purchased existing mortgages that were subject to imminent foreclosure and then issued new mortgages with repayment schedules of up to 15 years, which they later extended to 25 years. In addition, HOLC mortgages were amortized. If you all did not watch Realtors Roundtable on my YouTube channel called Carmelita a week ago when we had lender Scott Moon on from WEI, he talked about amortized and what that meant. But basically, amortized means that each payment that you make each month is not just an interest only payment. It does include some of that principal along with the interest, so that when the loan is paid off, the borrower will own the home. So now keep in mind, before that time, they were interest only loans, which is crazy. It was only in 1933 where they became amortized. Thus, for the first time, working and middle class home owners could gradually gain equity while their properties were still mortgaged. If a family with an amortized mortgage sold its home, guess what? That equity, including any appreciation, would be the family's to keep. What am I always saying? Home ownership, owning doors, is one of the first wealth foundations, one of the first ways to build wealth for yourself and your family. HOLC mortgages had low interest rates, but the borrowers still were obligated to make regular payments. So see, that's another important thing too. Not only were these loans amortized, but they had low interest rates. The HOLC therefore had to exercise prudence about its borrowers' abilities to avoid default. This is where it gets deep. To assess risk, the HOLC wanted to know something about the condition of the house and of surrounding houses in the neighborhood, kind of like when we talk about comps, that's where that comes from, to see whether the property would likely maintain its value. The HOLC hired local real estate agents to make the appraisals on which refinancing decisions could be based. With these agents, I mean, I'm sorry, with these agents required by their national ethics code, which we do have. We maintain a national ethics code as well as our state and local ethics as well. With them being required by their national ethics code to maintain segregation. See, back then, the code required them to do that. It's not surprising that in engaging risk, HOLC considered the racial composition of neighborhoods. The HOLC created color-coded maps of every metropolitan area in the nation, with the safest neighborhoods colored green and the riskiest neighborhoods, oh, you guessed it, colored in red. A neighborhood earned a red color if African Americans lived in it, even if it was a solid middle class neighborhood of single family homes. For example, in St. Louis, the white middle class suburb of Ladue was colored green because, according to an HOLC appraiser in 1940, it had, and I quote, this is from an actual document, not a single foreigner or Negro. The similarly middle-class suburban area of Lincoln Terrace was colored red because it had, quote, little or no value today due to the colored element now controlling the district. Although the HOLC did not always decline to rescue homeowners in neighborhoods colored red on its map, i.e. red line neighborhoods, the map had a huge impact and put the federal government on record as judging that African Americans, simply because of their race, were poor risks. I think I need to read that to you one more time. Although the HOLC, right, they didn't always decline to rescue homeowners in neighborhoods colored red on their maps. The maps had a huge impact and put the federal government on record as judging that African Americans, simply because of their race, were poor risks. So when people ask me, well, I mean, why is this so important? Well, I'll tell you why. When you live in a country where your own government implements policies and laws that do not even place you on a level playing field, and they work against you for decades, nay, hundreds of years, you are already starting out the game at a deficit. Let me remind you, listening audience, this is based on documented evidence. This is not the Realist Realtor's opinion. To solve the instability of middle-class renters to purchase single-family homes for the first time, Congress and President Roosevelt created the Federal Housing Administration in 1934. Oh yeah, good old FHA. The FHA insured bank mortgages that covered 80% of purchase prices, had terms of 20 years, and were fully amortized. To be eligible for such insurance, the FHA insisted on doing its own appraisal of the property to make certain that the loan had a low risk of default. Because the FHA's appraisal standards included a whites only requirement, racial segregation now became an official requirement of the federal mortgage insurance program. Let me say it again. No, I'm not going to break out the song. But because the FHA's appraisal standards included a whites only requirement, racial segregation now became the official requirement of the federal mortgage insurance program. I couldn't make this stuff up if I wanted to. It is all documented and on record. The FHA judged that properties would probably be too risky for insurance if they were in racially mixed neighborhoods, or even, check this out, in white neighborhoods near black ones that might possibly integrate in the future. When a bank applied to the FHA for insurance on a prospective loan, the agency conducted a property appraisal, which was also likely performed by a local real estate agent hired by the agency. As the volume of applications increased, the agency hired its own appraisers, usually from the ranks of those same private real estate agents who had previously been working as contractors for the FHA. To guide their work, the FHA provided them with an underwriting manual. The first was issued in 1935, and it gave this instruction. Let me say this, quote, if a neighborhood is to retain stability, it is necessary that properties shall continue to be occupied by the same social and racial classes. A change in social or racial occupancy generally leads to instability and a reduction in values, in frigging quote. Appraisers were told to give higher ratings where, quote, protection against some adverse influences is obtained, and that important among adverse influences are infiltration of inharmonious racial and nationality groups, end quote. The manual concluded that all mortgages on properties protected against such unfavorable influences, to the extent such protection is possible, will give them a high rating. So that goes back to what we talked about last week. Basically, those neighborhoods that produced HOAs or governing bodies that then in turn not only placed income restrictions, but then they placed racial restrictions at their local level, they would be given a higher rating by the FHA. The FHA discouraged banks from making any loans at all in urban neighborhoods rather than newly built suburbs, according to the underwriting manual. Older properties have a tendency to accelerate the rate of transition to lower class occupancy. The FHA favored mortgages in areas where boulevards or highways served to separate African American families from whites, stating that natural or artificially established barriers will prove effective in protecting a neighborhood and the locations within it from adverse influences, including prevention of the infiltration of lower class occupancy and inharmonious racial groups. I'm sorry, because let me tell you, before I even started doing this podcast today, just reading this and the way my brain works, just the gravity of the long-reaching effects from things of this nature, it makes me emotional. I'm not even going to lie. It really does make me emotional. The FHA was particularly concerned with preventing school desegregation. So here we go. And you can just sit in your chair or wherever you're listening to this podcast right now, and you can think of all the areas where you know that there's a highway or a railroad track or certain boulevard or road, major thoroughfare that separates one side of the city from the other. And then for them to not only say that, that those natural barriers are helpful, then they follow it up with how the FHA was particularly concerned with preventing school desegregation. Its manual, again, this is a document that was published, their underwriting manual, warned that if children are compelled to attend school where the majority or a considerable number of the pupils represent a far lower level of society or an incompatible racial element, the neighborhood under consideration will prove far less stable and desirable than if this condition did not exist. And mortgage lending in such neighborhoods would be risky. This is why realtors currently, we don't answer questions about, oh, well, what are the schools like? What's the school district like? Look, you heard what I just read. We don't have conversations like that for a reason. For a reason. Because look at what it grew from. Look at what it is based on. We do encourage people to do their own research. I mean, they can, this is all public information. They can find this information out on their own. We don't make judgments about anything one way or another. Let me tell you something. I've been in and out of so many homes and condos and townhouses. They all started looking like me. I don't care who the neighbors are. It's all the same. It's all the same. If a person is qualified and able to afford it, they should be able to live wherever the heck they want to. I don't care what color you are. It should not matter. It should not matter. Everyone deserves sanctuary. And I definitely want to make sure that I'm putting this information out to help even impact those folks who look like me, blacks who may not have this knowledge and this education. But I think it's imperative for everyone to hear it. Subsequent editions of the underwriting manual through the 1940s repeated these guidelines. So they kept, writing this manual with all the same racist bullshit in it for years. In 1947, let me tell you what they tried to do. They removed the words like inharmonious racial groups. That's 3 words, by the way. They took those words out from the manual, but they barely pretended that this represented a policy change. It was not a policy change. They just took those words out. The manual still specified lower valuations when, quote, compatibility among the neighborhood occupants was lacking. And to make sure there was no misunderstanding, the FHA's head told the Congress, mind you, this is a government agency telling the Congress that the agency had no right to require non-discrimination in its mortgage insurance program. The 1952 underwriting manual continued to base property valuations in part on whether properties were located in neighborhoods where there was compatibility among the neighborhood occupants, meaning, all white of the white, white or a compatibility deemed appropriate by the FHA. FHA policy in this regard was consistent. In 1941, a New Jersey real estate agent representing a new development in suburban Fanwood, which it says here is about 20 miles west of Newark, attempted to sell 12 properties to middle-class African Americans. All of them had good credit ratings, and the banks were willing to issue them mortgages if the FHA would approve. But the agency stated that no loans will be given, and this, I'm sorry, I should have said, quote, no loans will be given to colored developments, end quote. Again, government agency. These same blacks were paying taxes then as we do now. When banks told the real estate agent that without FHA endorsement they would not issue the mortgages, he approached the Prudential Life Insurance Company, which also said that although the applicants were all creditworthy, it could not issue mortgages unless the FHA approved. Even today, Fanwood's population remains 5% black in a county with a black population of about 25%. In 1958, a white San Francisco school teacher, Gerald Cohen, purchased a house with a FHA guaranteed mortgage in the Elmwood district of Berkeley. By the closing date, Mr. Cohen, the white purchaser, he wasn't ready to move in, and while keeping up his mortgage payments, he rented the house to a fellow teacher, Alfred Simmons, an African American. The Berkeley chief of police asked the goddaggone FBI, Federal Bureau of Investigation, to inquire how Mr. Simmons had managed to get into this all-white community. This is 1958, by the way, okay? Not too long ago. The FBI had the goddamn nerve to come out and question Gerald Cohen's neighbors in San Francisco, but they failed to find evidence that he had obtained his mortgage under false pretenses. In other words, that he had never intended to occupy his Berkeley home, but had always planned to rent to an African American. Because his neighbors probably said, well, no, he told us he was moving. It was just, something came up. He just wasn't ready to move at that time. He just decided to rent it until he was ready to move. But feel me on this. The chief of police in an area was able to activate the FBI to investigate a matter of housing, who someone rents a home to that they have secured legally, they have a mortgage on, that they're not late in paying. The FBI referred the case, it gets worse, to the U.S. attorney, who, thank goodness, refused to prosecute because no law had been broken. No, I'm sure they probably tried to figure and finagle as much as they could, but he wouldn't prosecute. He's like, dude, there's no law that's been broken here. The FHA, however, they weren't satisfied. They then blacklisted Mr. Cohen, advising him that he would be denied the benefits of participation in the FHA insurance program and never again be able to obtain a government-backed mortgage. Oh my God. The director of the San Francisco FHA office wrote to him, quote, "This is to advise you that any application for mortgage insurance under the programs of this administration submitted by you or any firm in which you have 10% interest will be rejected on the basis of an unsatisfactory risk determination made by this office on April 30th, 1959. In thousands of communities between Fanwood and Berkeley, FHA policy was the same, with very few exceptions. No guarantees for mortgages to African Americans or to whites who might lease to African Americans, regardless of the applicant's credit worthiness." All right, I'm about to stop there because I think that's about all I can take for today. But this is important information to hear, and it is indeed important information to know. And you will see when we talked about, the different types of loans on my YouTube channel, we spoke about FHA, conventional, we touched on VA a little bit. Government loans backed by the government include FHA, USDA, and VA. Okay, those are government insured or government backed loans. Loans that are not backed by the government are conventional loans. My call to action to you today, as it will be always, is a couple of things. Number one, secure your credit. Get into the 700 Club Plus. Guard it and protect it and maintain it forever and ever and ever. When your credit is strong, there's some level of minutia that you can avoid. There's that part. Number two, please read and educate and research for yourself. OYO means something to me. We must own our own education, our own knowledge. We have to take accountability for that. We need to be responsible for that. If you are understanding what your goal is, then you will then understand the path that you must create for yourself. But that won't happen without educating yourself. Stop thinking that your cousin Boo Boo and them know more about what you need to do to be out here owning dirt and doors than the realest realtor or whatever agent that you may be working with. If you feel like your agent isn't giving you the knowledge that you need, then my God, you better find another agent. The third thing, live below your means and tuck away money for yourself. Secure money for yourself so that when it comes to, having to do a down payment, you won't have to rely on anything outside of yourself. People can gift you. We talked about this on the show on Realtors Roundtable, so I advise you to go over and watch it. There's several ways you can identify funding to have either for a down payment or to purchase a property outright. Yes, all of these things are possible. So I hope that you found some value in this information. I think for many of us, it's newer information, or maybe not. I do encourage you to read The Color of Law by Richard Rothstein. But most importantly, I do encourage you to keep coming back every Wednesday at 3 p.m. and joining us here on The Realist Realtor. I so appreciate all of you that support me and encourage other people to come and listen and support. Please encourage folks that you know and on your platforms to follow me on YouTube, call Carmelita, where they can always continually get valuable content from me. I leave you in the manner in which I came, folks, and that's in peace. Take care. Thanks for listening to the Realist Realtor podcast. Head over to Call Carmelita for Real Estate, all spelled out, on IG, and look in our bio to click on our link so you can connect with us across all platforms. Please subscribe to the podcast here on Anchor and Spotify, and we'll see you next week.